Hi, I'm Kevin Nunez, investor, entrepreneur, and professor. I grew up in a part of New York City where nobody was talking about saving or investing. We were in survival mode. I earned my bachelor's degree from Fordham University and an MBA from Cornell University. I worked my way up Wall Street firms like Morgan Stanley and Merrill Lynch. I did everything you're supposed to do. And I could have kept climbing that ladder, but I chose something different. I chose to build. I chose to teach. I chose to invest in our communities because too many families are often fed bad information about money and it costs them generations. So this is Invested in Us, where we break down money, markets, and ownership so our communities can build real wealth and real legacy.
Hey everybody, my name is Kevin Nunez, founder of NJK Partners, and welcome back to another episode of Invested in Us, where we teach money how it should have been taught to us. Now, I am excited about today's episode. It is issue 25, and a common debate in the investing world is, what's a better investment? What would you prefer to own? Would you prefer to own a private business or would you prefer to own a private real estate asset? But today I'm going to talk about a common playbook used by investors to actually acquire both. So first, let's talk about the state of the markets because not much has changed since our last conversation. Here's the inside baseball. The three major averages in the United States of America are all hovering around all-time highs. No surprise there, to be honest with you. We are honestly in a deregulatory environment, which makes, conducting business slightly easier. Businesses like that. We're watching year over year record-breaking quarterly profits. I mean, in some cases, you are seeing north of 20% earnings just compared to last year. So these companies are honestly printing money. So that's pretty much why you're seeing these stock prices pop. Now, it's been a volatile year because you obviously have, geopolitical tension all around the world, specifically in the Middle East and in Europe, which has been basically putting pressure on inflation, putting pressure on, cost of living and everyday, goods and services. So it's spooky out there. But for the people that have assets, the people that have remained invested, and the people that buy investments, whether it's stocks, bonds, real estate, or businesses, they're watching their assets appreciate in value. And if you own enough assets, you're making money. So this is unfortunately why economists talk about a K-shaped economy, because the lower income, low skill, unfortunately less haves, don't own that much assets. So when inflation happens, they're the ones that get impacted the most versus the people on the upper end of that K-shaped economy who do own assets and are enjoying in the appreciation of stocks, real estate, business valuations. So that's why I'm on a mission to teach financial literacy, because my community has to step in. You got to get in the game. This doesn't work by just trading your time for hourly wages. You need your money to work for you. If I got to go to work, wife got to go to work, my kids got to go to work, the money has to go to work. You cannot just sit there in a savings account watching your, money be eroded by inflation and your purchasing power decreasing. You got to get in the game. So with that said, what's really going on in the state of the capital? People are making money, and the people who are invested are getting smoked. Now, something I am looking out for in the capital markets is basically the bond market. The bond market, quietly interest rates continue to creep up, and we're seeing some pretty historical numbers that we haven't seen in decades, and that does not give me that much comfort. The federal government and their finances, which is in shambles, to be honest with you, and I look around state and local municipalities finances, a lot of them are in shambles. So, and with inflation creeping up, the only way to combat that is by rising interest rates. And with America's credit deteriorating and their finances deteriorating, I don't see how interest rates are going to come down. If you've ever purchased a car before, purchased a house, you already know. If your credit sucks, you pay higher interest rates. So that's how it works in the bond market. When America's credit, continues to deteriorate, interest rates are spiking up. So, more to come on that. But those that are in the market for a home, car, credit cards, they have a tough time right now because we're all seeing higher interest rates. And of course, it doesn't help that home prices are all-time high and everything is just way too damn expensive. So, that's the real state of the capital markets. The common question is, what's a better investment? Would you prefer to own the business or would you prefer to own the real estate? Now, I'm going to tell you guys about what's called a SBA loan, which in some cases allows you to acquire both in the same transaction. And this is honestly a hidden gem that I don't see many people talking about. So thankfully, the SBA loans make this available to a pretty wide audience, and this is a great wealth generator, especially for the everyday person, because I always tell my students, don't trade your time for money. Go out and buy assets, make those assets appreciate, and that's how you're going to watch it compound. So in the case of an SBA loan, if you find a business that's cash flowing and the business just so happens to own a real estate piece, or I guess in some cases, an SBA loan will allow you to do a 10% equity injection, allowing you to buy that business for a 10% down payment and the assets that come with it. And, now you own and operate that business. And, if that business owns a real estate asset, you now own that real estate asset as well. So, most people look at a $5 million business and think, oh, I need $5 million to buy that. Well, let me introduce to you the idea of what financial professionals call the capital stack. And by the way, of course, when we say capital, you mean money. But all the capital stack means is, how are we getting this deal done? If the deal is $5 million, for a $5 million transaction, a common way to structure that would be a 10% equity injection, right? So $500,000 down payment. Think of it as you're buying a house, but in this case, you're buying a business. $500,000 down payment, and you're buying a $5 million asset that may have a real estate piece attached to it. So, and of course, the banks are going to step in and provide you the difference. And if you really structure this thing well, you might be able to get what's called seller financing, meaning the person selling you that business might lend you some of the money, for you to buy that business so that the banks don't have to spot you all of the 90%. And, in some cases, the seller might even be willing to hold off until the bank gets paid first. So that makes it a really, really attractive deal for the banks. So, these are just levers that you can pull to create value. Because if you look at $1 million business and all you need is $100,000 10% equity injection, aka down payment, $100,000 isn't so scary for most people, especially if you have, a cousin, an uncle, or this or that that's like, hey, would you invest 10 or 15,000? Would you invest 20,000? Can I count you in for 50? And now you pool together your down payment and you can buy a $1 million business, a $5 million business with just 10% down. And of course, the trick here is to not buy a distressed asset, right? Don't buy a business that's going out of business. But that's what you do the upfront research for. That's what you do the upfront diligence for. And as long as you buy a business that's cash flowing, if the business does $5 million in revenue and it's a 30%, net, you're talking $1.5 million for $500,000 down payment on what was originally a $5 million business. And don't forget, you're obviously going to have to make debt payments on that. So don't just think, wow, I'm going to triple my money in the first year. But if the business doesn't decline significantly, you're going to make some money. And these are just simple levers that you can pull, that the wealthy pull all the time to create value add and to create wealth. And they don't just wait, to make $20 an hour, $100 an hour, $200 an hour. They go out there, they hunt, and they get it. Now, from a policy and economics perspective, it's the policy that allows people to do that. You don't have to be a Wall Street investor to do an SBA loan. Anybody, you obviously have to be qualified, but just about anybody could do an SBA loan, and you can run that same play for yourself and go ahead and, buy a business and create that value. But that's policy that allows you to do that. There was a law that passed that allowed people to do that. And of course, it makes the whole system go round, because if you have an entrepreneur that built a business who's getting ready to retire, but the business is a good business, maybe it's a staple in the community, why would that person want to close down your legacy? They can just sell it to the next buyer, maybe an entrepreneur who's 30 years younger and wants to continue building upon that legacy. So by having SBA lending, you have a bridge that satisfies that need, and that pushes the economy forward. And that's what makes America such a strong, economic powerhouse. Capital markets that move the economy forward. In this example, the banks are making a loan. You have a seller that's getting a liquidity event who's making money on the sale of their business. Then you have an entrepreneur who's acquiring a business, who's likely going to keep growing that business. And you have people that are employed throughout the whole process. You have the banks that are making the loan, and likely the banks are going to pile that loan with other loan and then compile them together and sell them off to bond investors, right? And then that feeds the ecosystem, that keeps the machine going. So in my humble opinion, it's these policy decisions that, allow the economy in America to run rampant, and that's what makes us a powerhouse. So in reality, there's no right or wrong answer here. Everything would be subjective to you. There's no one size fits all. That's why it's always important for people to focus on their goals, what they're trying to accomplish, what's their appetite risk, right? And how much risk are they willing to take versus the reward that they're looking to get. And if there's a misalignment in the two, then we should probably go back to the back of the napkin and do some more math so that we can all get on the same page here. I always say we should make investment related decision off of data, not vibes. And I mean that for a reason. So, I hope you all find this helpful, because the reality is creating wealth, it boils down to one sentence, in my opinion. It's all about buying, appreciating assets and holding them for a long period of time. So with that, folks, I hope you found this informative. I hope you found this helpful. I'm always available to help out if you have any questions about, your personal situation, or if you know someone you think will be benefiting from these conversations. Please keep me in mind. I am in growth mode, and I'm, this is a passion thing for me, and I just love to help people. So with that, I want to thank you all again for watching another episode of Invested in Us, where we teach money how it should have been taught to us. My name is Kevin Nunez, founder of NJK Partners, and I'm looking forward to seeing you all next week, y'all. Peace.